Brazen.
There's an apartment building in Brooklyn at the center of a new real estate bet.
So I think the important thing to understand about this building is that it is special because there's nothing particularly special about it.
This is reporter Ben Walsh.
There are thousands and thousands of buildings like it in New York City.
The building Ben's talking about is 4 stories high, and it's called a walk-up. It has no elevator.
Once upon a time was probably the home for an extended family of 8 to 10 people, including potentially some staff. But a long time ago, it was chopped up into apartments. And it's on a block with several other nearly identical buildings in a row.
It's in Brooklyn's Bed-Stuy, a historically Black neighborhood that's had significant waves of gentrification over the years.
It's seen an influx of younger white residents who are looking for lower prices and a little more space than you can get in Manhattan or in other parts of Brooklyn that have been, expensive for a longer period of time.
In 2015, the building was bought for $1.25 million by an individual who works in insurance. He bought the building as a personal investment.
That's a sort of classic mom and pop landlord situation. The building had 4 apartments when he bought it. He remodeled it and expanded it, and it now has 8 apartments in the building. And in 2022, it was sold for $4 million.
But the buyer wasn't just another individual landlord. It was one of the biggest names in finance.
The private equity firm Carlyle.
Private equity has been involved in real estate for decades, but the Carlyle Group has quietly been building a portfolio of assets in a real estate class most big players have shied away from: small rental buildings in Brooklyn.
It is a bet that the housing market in big cities like New York is going to stay as punishingly expensive, with as excruciating limited supply and as much overwhelming demand as there is right now.
And in buying up these small apartment buildings one at a time, they've built a deal-making machine that's become the envy of their private equity peers.
Real estate is is this thing that's all around us, but no one is really paying attention to who owns it unless something bad happens or unless something is changing.
In this case, something is changing. It's the balance of power in an asset class that's historically been shared by smaller investors. This is The Closer. I'm Amy Keene. We've been talking about investment in real estate for a while behind the scenes here at The Closer. We've come across countless headlines of big private equity names raising money for new real estate funds and investing billions of dollars in property across the U.S. We've also followed the news that the commercial real estate market's been in trouble with fewer people returning to the office than a typical office building was designed for. But in the case of residential real estate, we wanted to know where the new investments were being made and how that investment might affect the housing that's available.
Housing is something that I think a lot about. It's a big part of the experience of living in New York City. And my friends and family have all had some tough housing experiences in the past.
That's Ben Walsh again.
And for me personally, when my son was just starting to crawl, we found a significant amount of lead paint in our previous apartment. And we reported it to the landlord. The landlord was dismissive. And we knew we had to move out because we didn't trust the landlord to remediate the lead paint in a safe and timely manner. And we also reported the existence of the lead paint to the Department of Buildings because we wanted it remediated so that it was gone. And the landlord's response was to serve us with eviction papers. I think it just underscored how hard it is. It's very difficult to find a good apartment in your price range, whatever your price range is. It's just really tough.
Finding housing in a big city can be tough across price ranges. And while you might be primarily concerned with whether the rent is in your budget, it can be useful to know who's looking at your home as an investment opportunity and the bet they're making. So Ben, who you've heard on this show before, set out to find what new bets investors are taking in residential real estate.
Well, there's this guy I talk to from time to time about the New York City real estate market and housing. His name's Ben Typin, and he's a real estate broker who represents individual investors and also sometimes institutional buyers and investors of real estate.
That refers to private equity, but also endowments and pension funds.
And we were talking about how to do an episode about the institutional money that are pouring money into the residential real estate market, the housing market. And so I called up Ben and I said, what do you think about this idea for an episode? And he said, that's great. Who can we get to talk about this? What's the story? What's the deal? And he said, I don't want to pull a Dick Cheney, but I'm the man for the job. I've got the deal. And it's Carlyle, the private equity firm, and they're buying up apartment buildings in Brooklyn.
Here's broker Ben Typin.
Carlyle came up with a very interesting strategy here and recognized that this small building market offered several advantages relative to the large buildings, and all that was standing in the way of deploying a lot of capital, as much capital as they could into large buildings, was building a machine to deploy it.
We'll get to that machine in just a minute. But first, Carlyle.
So Carlyle is among the oldest private equity firms and is one of, a handful of firms that really kind of created the business model of private equity.
It was founded in the late 80s during the peak of the leverage buyout boom and became known for its takeovers of big names like aerospace and defense companies, car rental company Hertz, and more. It runs a series of real estate investment funds too, but its Brooklyn apartment building strategy takes a different form.
So the reason that Carlyle's real estate strategy and this particular strategy is interesting is because it's so different from the general private equity model and the model that we've seen other private equity firms take in real estate. So a competitor to Carlyle, Blackstone, is very active in the real estate space, and they have done a number of very large deals for apartment buildings around the country. And kind of the classic canonical example of that is in New York City. They bought Stuytown. It's a massive apartment complex, and they did a $5 billion deal to buy it out. 10,000 apartments in nearly 110 identical buildings on an 80-acre site in Manhattan. In that deal, you can see how it's very similar to a large leverage buyout that a private equity firm would do of, say, a public company. It's one asset, you do it once, you hold it for a long time, and then you try to sell it eventually. What Carlyle's real estate model does is very different. So they've specifically targeted this huge asset class in New York City, which is the thousands and thousands of unregulated, tax-advantaged apartments in neighborhoods with limited supply and huge demand.
The buildings Carlyle's interested in typically have the following characteristics. No elevator, which means lower maintenance costs. Fewer than 10 units, which means that the amount the building's property taxes can increase each year are capped. There are also advantages to Carlyle going even smaller. Buildings with fewer than 6 units are usually exempt from New York City's rent stabilization rules.
And for a long time, I think that private equity would have looked at those kinds of apartment buildings and said, well, there's nothing we can do here. We know they're everywhere, but we can't really get our capital into them. It's sort of a classic water everywhere and not a drop to drink kind of situation. But Carlyle figured out how to build a straw.
So what is it about these buildings that's so appealing to a firm like Carlyle? Ben says there are 2 factors. The first has a lot to do with the financial conditions that came out of the global financial crisis.
The housing crash and financial crisis happened in 2008/2009. And as a result, the Federal Reserve slashed interest rates to near zero for years to try to stimulate economic growth and home building. And that did a couple of important things to financial markets. The first thing it did is it pushed investors like pension funds, endowments, sovereign wealth funds to send billions and billions of dollars to private equity firms to invest on their behalf, because bonds, a place that those kinds of institutions normally invest in, were giving such measly returns because interest rates were so low. Chasing yield was the phrase that you heard in the financial press at this time. These institutions were chasing yield. And at the same time, private equity firms had another advantage, which is that those low interest rates meant that they had access to cheap loans to finance the investments that they were making. So they had a huge influx of money, and they were able to borrow at a very cheap rate in order to invest that money.
The second factor is the changing demographics of people looking for housing in big American cities.
And you also had a situation where big cities were seeing a big influx of young, highly educated white-collar workers who in a previous generation would have been homeowners either in those cities or in the surrounding suburbs. But for a number of reasons, they were priced out of homeownership and they wanted to live in big cities, so they rented. And they are willing to put a large amount of their income towards their rent and able to. And so private equity sees those people as a really lucrative market to rent to.
Add to this the fact that housing supply lags behind the growth of new residents in many of these cities.
The bottom line is that big cities are just not adding enough of any kind of housing, not enough affordable housing, not enough family housing, not enough luxury housing even. So take New York City, for example. New York City has added 629,000 residents, 900,000 jobs, and just over 200,000 new housing units.
This is over the 10-year period from 2010 to 2020. This is where Carlyle spots an opportunity: rental real estate. Where it might have traditionally bought and sold real estate as it would another company in the past, big office buildings, maybe even a big apartment building, now it's looking across the sector with smaller, reliable assets. This is what they did with that apartment in Brooklyn that Ben Walsh told us about at the top of the show, the one that the insurance salesman bought for $1.25 million in 2015, renovated and expanded. He was broker Ben Typen's client.
And he got some money together around 5 years ago or 6 years ago and bought this building, did some renovations to it to increase the rents or increase his the ability to get higher rents. Had been running it pretty stably until I approached him to see if he would sell to more institutional investor that has become very active in this market.
That institutional investor was Carlyle.
So most investors in this market would first they'd take the seller's word for it that it's free market.
They'd likely hire a landlord-tenant attorney, have this attorney review the history and laws of the building, and proceed with the transaction.
And that would be the extent of it. What Carlyle did is very different. This is before they even make an offer on the building, before they even go to the building. They ask for all of this paperwork up front. And not just the history of the rents, but for example, the original sales contract from when the seller bought the building, canceled invoices from contractors who did the work on the building that was part of deregulating it, agreements from old tenants saying that they were leaving from the building on their own accord, and all sorts of other things. They do all of this work up front to determine whether this is even worth their time. That process, can wind on, particularly for a seller who didn't expect to have all this paperwork at all, much less ready to go.
Then Carlyle's team of professionals swoops in.
So they have, one law firm handling all of this. They have a fleet of consultants, and they have a broker that represents them that does a lot of review as well. Because it's not just regulatory paperwork with respect to rent regulation, it's also looking at building permits to make sure that the work that was done in the building matches the work that it was authorized, and close out a permit on a small building. Same thing with like a building violation. That these are things that most investors in this market who are not institutions would overlook in a closing. They would know that they're there, they just wouldn't care. They figure, all right, I'll pay off this $200 fine for not filing a boiler inspection report later. I don't need to do that before the closing. Whereas Carlyle is evaluating all of these things up front. And eventually they came to a price.
$4 million. This is for a 4-story walk-up in Brooklyn with 8 units that was purchased for a fraction of that in 2015.
Usually what would happen in a transaction like this, or involving a property like this, is that after people agree on price, the lawyers start drafting a contract. But if you recall, Carlyle still hasn't even visited the building. So what happens here after agreement on price is that they then go and visit the building. with their fleet of consultants who inspects every nook and cranny of the building to make sure everything is the way it's supposed to be. And then if it passes the tests, they go to contract.
So what's the point of waiting to send anybody?
Because this machine is both an in-house machine, but also a external machine. And they don't want to pay more in consulting fees unless they know they have a deal.
It's an onerous process for the seller, but it can be worth it given the premium Carlyle is willing to pay if they think it's a worthwhile building. Here's Ben Walsh again.
Carlyle is very firm on its pricing, but it's also very generous because it has developed an intricate financial model for how they can make money off of this building for buying it at XYZ price. And so if XYZ price is above what the market would normally pay for that building, that's fine because Carlyle has a really detailed understanding of how much money they can make off of that apartment if they pay XYZ price.
There's the premium, yes, but also certainty that this transaction will close. Here's broker Ben Typen again.
You know, if you do a deal with them, you know that it's going to close. Whereas, you know, if you're doing a deal with someone that you've never heard of before this transaction, instead of a brand name like Carlyle, you have no idea whether they could close. You might be tied up in contract with them for years because they don't have the money or some other thing happens that causes them not to close.
And the premium, along with that certainty, has created demand for the specific type of small Brooklyn apartment building.
Carlyle routinely pays a significant premium to other investors in the marketplace, such that there is basically a premium for the kind of building that Carlyle likes to buy if Carlyle is buying it. And if Carlyle is not buying it, there's a different price effectively in the market. So it's caused a kind of pretty unique dislocation in the real estate market.
Yeah, and I'm imagining creating a little incentive pipeline for independent investors to, fix up their buildings, deal with all of, any potential infraction, put on a fresh coat of paint and maybe put in new appliances so that the building is ready to go for the very renters we've been talking about.
Yeah, absolutely. If you are Carlyle and you're looking to create a pipeline of building owners who are willing to sell, having the market know that you'll pay a nice premium and that you've done the work to make that premium make sense to you is not a bad way to incentivize supply.
Here's some perspective on just how big an incentive Carlyle might be making. In quietly building up one building at a time, the firm's built a portfolio worth $500 million already. They're consolidating power in an asset class that's historically been made up of individual investors.
Every broker I know deals with them, and we kind of joke that we're in an abusive relationship with them. We have to show them deals because they're going to pay our clients the highest prices. What's so interesting to me is I think it's really a reflection of innovation in an evolution of capitalism. Capital is being pooled in response to a chase for yield, on behalf of institutional investors, retail investors, wherever the money is coming from, and being deployed by very sophisticated parties that have to become increasingly creative to effectively deploy the capital. And I think this is but one example of that. And I think it's something we're going to keep seeing in the market, whether it's Carlyle or someone else. And I don't think it's the worst thing in the world that people that are in the business of deploying capital into productive assets are focusing on that, and people that are in the business of, being a baker or something that happen to own a building, their money is better served, opening a new bakery. Real estate is this thing that's all around us, but no one is really paying attention to who owns it unless something bad happens or unless something is changing, like someone's building a big new building or something.
You mentioned sort of all the reasons why a big private equity shop wouldn't want to buy a building one by one. Why are they so envious? What is it about what Carlyle has done that makes them so envious?
I think the main reason is that it already exists. They've done all the work, the painstaking work to build the machine and put in all these procedures and create this network of consultants and all these checklists. And it's a lot of, it's building a real operation that most institutional real estate investors are not willing to do unless it's really worth their while.
It's the envy of their peers by virtue of the fact that it exists. Let's take a quick break. When we come back, where does Carlyle's deal-making machine fit within the broader housing market? Ben Walsh told us about two factors that made small apartment buildings in Brooklyn an attractive investment for Carlyle. One was the changing demographics in big cities like New York. The other was the low interest rate era that followed the 2008 financial crisis. Ben, this machine of Carlyle's has been built coming out of an era of low interest rates, right? But of course, in the last year, rates have gone up. Does this model still work in a higher rate environment?
That's a really interesting thing about this strategy, which is that, yes, it does. Because if you think about the advantages that Carlyle has over an individual buying the home to live in or an individual buying a home to invest as an investment, Carlyle has access to cheaper loans because of the size of its institution and its relationships with financial institutions. And also, as interest rates go up, individuals are priced out of buying buildings because it becomes more expensive for them. And Carlyle, needless to say, is not priced out. And as individuals are priced out of buying homes, what are they going to want to do? Rent. And so I think Carlyle has sort of found itself, even as interest rates rise, in a sort of heads I win, tails you lose scenario.
There's quite a layered backdrop against which this Carlyle strategy is taking place. For one, there's been a lot of reporting on some of the consequences, some of the downsides for tenants having private equity landlords. But more specifically to this case in New York, there's such a considerable housing shortage. What should we make of Carlyle's role here?
They are quite literally capitalizing on tight supply in the areas that they're buying homes in. And I think that there is a argument to be made that in some cases, large institutional landlords are better for renters than small, cash-strapped independent landlords. There are lots of cases that you can see in the marketplace of large institutional landlords having the ability to put money into apartments and renovate them and maintain them properly, and also of small independent landlords being really stingy about repairs, not really understanding the market and putting in kind of price hikes at times when it doesn't make any sense. Just because you have a mom and pop landlord doesn't mean they're necessarily a good landlord. I think that the overall dynamic of the housing market in New York City of massive undersupply, huge demand, Carlyle will continue to profit from if it maintains its sort of status quo.
Here's how broker Ben Typin sees Carlyle's role in the rental housing market.
It's always good to know who your landlord is. And I think, as I mentioned before, I think the institutionalization cuts both ways. It makes it a more professionalized business where you're dealing with a perhaps more responsive counterparty who has a different set of interests than the less professional owner. I think a lot of people would rather fly on an airplane operated by a major airline than by some guy that they just met when they got to the airport. So I think it's not necessarily a bad trend. I think it's, in some ways, morally neutral and really a reflection of the underlying system. So if Carlyle is doing bad, which I'm in no way saying they are, if they are raised rent a very high amount on some tenant, that's not happening because they're Carlyle. It's happening because the law allows them to do that. They're not getting preferential property tax treatment because they're Carlyle. They're getting preferential property tax treatment because small properties get preferential property tax treatment, and there's all sorts of arguments why that's not necessarily good public policy. So I think why people should care about this is that it's, from a social perspective, is that it's a reflection of the broader landscape, and capital is merely finding a way to take advantage of it. But these issues existed before Carlyle.
In reporting this episode, we reached out to Carlyle to ask them if they had any comment. They didn't reply. Ben Walsh, as you've been reporting this story out for us, you're, of course, an avid watcher of the housing market. What was most surprising to you?
I think the most interesting thing is that Carlyle is seeing the same trends that renters are seeing. They're seeing, man, it's hard to find a nice apartment. They're seeing, oh man, my landlord increased my rent again, but I don't really have an option. I guess I'll stick around, you know. They're seeing, well, this building could be nice, but the owner just hasn't done much to the building for the last 3 decades. So it's kind of a dump, but it's in a great neighborhood, but I don't have $4 million to buy it. They're seeing the exact same things that individuals are seeing, and they're seeing it from a different perspective. And they're taking action in the way that they know how and in the way that their institution is set up to.
This is a New York story. This is a very specifically Brooklyn story about a specific type of housing in a specific sort of high demand rental market. But as we see demand for rental housing in other big cities, do you see the Carlyle model expanding outside of New York?
I see no reason why this kind of model would not work in a number of other large cities in the US, where demand for rental units is very high, supply is very low, and you have a large cohort of well-paid white-collar professionals willing to pay a large amount of rent.
And that's the end of our show. But there's more from Ben Walsh's reporting on this deal-making machine. On Brazen Plus this week, we speak to writer Patrick Sisson about the constellation of zoning rules and codes that have created an ideal environment for Carlyle's strategy to work. Find this Closer Extra episode on Brazen Plus on Apple Podcasts. The Closer is a production of Project Brazen in partnership with PRX. Our show is produced by Isabel Kirby-McGowan and Ben Walsh. Mariangel Gonzalez is our project manager, Olivia Mead is our researcher, and Lucy Woods is head of research. Golda Arthur is our showrunner, and Bradley Hope and Tom Wright are executive producers. Megan Dean is programming manager, and Ryan Ho is design lead. Our marketing consultant is Maggie Taylor, and Noor Abdel Latif is our podcast strategist. I'm Amy Keene. Thanks for listening.